Welcome back to This Week in Finance, your go-to weekly recap for everything that moved the markets. This is your recap for the week of April 20th through April 24th, 2026. Whether you are a seasoned investor or just getting started, this channel exists for one reason: to take the biggest stories from the most respected financial outlets in the world and bring them together in one clear, unbiased place so you can stay informed, spot trends early, and make smarter decisions with your money. Every single week, we cut through the noise, skip the sensationalism, and give you what actually matters. No fluff, no filler, just the financial intelligence you need delivered in a format that respects your time. So if this is your first time here, welcome. And if you are a returning viewer, great to have you back. Let us get straight into it. Quick but important note before we begin. Everything in this video is strictly for educational purposes only and does not constitute financial advice or investment recommendations. Investing involves real risk, including potential loss of principal, and past performance never guarantees future results. Always do your own research and consult a qualified financial professional before making any investment decisions. Now, let us get into what was a genuinely fascinating week across global financial markets. Alright, with the housekeeping out of the way, let's get into what you actually came here for. Over the next 15 minutes, we are going to move through this week's most important financial developments in a way that actually connects the dots. We will start with a deep dive into the energy sector, where geopolitical uncertainty is keeping things interesting. Then we will move into financials and rate-sensitive names, followed by technology and growth stocks and defensive sector rotation. After that, we have a dedicated crypto update covering Bitcoin and Ethereum before wrapping everything together into a clear, actionable market takeaway for the week ahead. Think of this as your financial command center for the week of April 20 through 24. 2026. On your screen right now, you can see the key geopolitical hotspots influencing markets this week alongside our weekly calendar of major events and catalysts. Let's get into it. Now let's get into the meat of this week's coverage, starting with energy, because this is where a lot of the macro tension is being felt most directly right now. Iran's ceasefire negotiations remain unresolved, and that uncertainty is doing exactly what you would expect, keeping oil prices on edge. If you look at the animated tracker on screen, you can see Brent crude and West Texas Intermediate have been swinging meaningfully throughout the week, reflecting how sensitive markets are to every headline coming out of the Middle East. Here is why this matters beyond just the energy sector. Oil price volatility feeds directly into inflation expectations. When energy costs stay unpredictable, it makes the Federal Reserve's job considerably harder. The Fed is already walking a careful line heading into summer, balancing stubborn inflation against slowing growth, and this geopolitical noise is adding another layer of complexity to an already difficult calculus. Staying within the energy sector, let's talk about what this volatility actually means for specific stocks on your radar. ExxonMobil and Chevron are two names worth watching closely right now. Both reported earnings recently, and both showed solid operational performance, but here's the catch. Their stock prices remain highly sensitive to where oil settles week to week. When Brent crude swings $5 in either direction, these names feel it almost immediately. Exxon demonstrated stronger upstream margins, while Chevron showed disciplined capital returns through buybacks. Both positives, but neither insulates them from macro headwinds. So here is the balanced take. If you are already holding energy positions and sitting on gains, trimming into this current strength is a reasonable move. Lock in some of that upside. If you are on the sidelines, patience is your friend. Wait for oil prices to stabilize and look for a cleaner, lower-risk entry point before committing new capital. Shifting now to financials and rate-sensitive sectors, and this week the Federal Reserve held rates steady once again, reinforcing what many are now calling a prolonged pause in the rate cycle. The decision itself was widely expected, but the language coming out of the meeting leaned cautious, suggesting cuts are not imminent heading into summer 2026. For banks, this creates a genuinely mixed picture. On one hand, net interest margins continue to face compression as the spread between deposit costs and lending rates stays narrow. Banks that relied heavily on that margin expansion from the aggressive hiking cycle are now feeling the squeeze. On the other hand, loan demand is not collapsing entirely. Certain segments, particularly commercial lending and select consumer credit categories, are showing pockets of resilience that are worth noting. So the story for financials right now is nuanced, and that nuance matters when evaluating individual names heading into the week ahead. Zooming in on specific names, JP Morgan and Bank of America are the two institutions worth watching most closely coming out of this banking earnings season. JP Morgan delivered a notably strong quarter on the trading revenue side, with markets division performance coming in well above expectations, driven largely by fixed income activity amid elevated macro uncertainty. That is a meaningful tailwind for the stock, though it is worth noting that trading windfalls are not always repeatable quarter over quarter. Bank of America told a slightly different story, with deposit trends drawing the most attention from analysts. Deposit stabilization has been a key concern for the broader banking sector, and early signals here are cautiously encouraging. Shifting briefly to real estate investment trusts, these remain under meaningful pressure in a higher for longer rate environment. With borrowing costs staying elevated, refinancing risk and valuation compression continue to weigh on the sector, and caution remains warranted for investors considering new exposure here. Shifting now to technology and growth stocks, and this was a week where risk sentiment was anything but steady. Geopolitical headlines dominated the conversation, and the Nasdaq felt every single ripple in real time. If you watch the intra-week chart, you saw sharp swings in both directions, with some sessions opening strong only to reverse hard by the afternoon close. Here is the core dynamic you need to understand heading into next week. Growth stocks, particularly high multiple names in artificial intelligence, cloud computing, and semiconductors, remain extraordinarily sensitive to macro headlines right now. These are companies priced for perfection, and the market is not forgiving when uncertainty spikes. Any fresh escalation in Middle East tensions, any surprise commentary from Federal Reserve officials, and you can see 3 to 5% intraday moves in some of these names without a single company-specific headline driving it. That is the environment we are navigating right now, and positioning accordingly is absolutely critical. Staying within the tech space, one name continues to rise above the noise, and that is NVDA. Even during the broader market pullbacks we saw midweek, institutional flows into NVIDIA remained notably supportive. That tells you something important. When smart money holds its position through volatility, it signals conviction in the underlying thesis. And the thesis here is straightforward. NVIDIA's dominance in artificial intelligence chip demand is not slowing down. Data center buildouts, large language model infrastructure, and sovereign AI initiatives globally are all funneling demand directly toward NVIDIA's product stack. That said, the narrator wants to be measured here. The long-term story remains as compelling as ever, but near-term valuation is stretched by almost any traditional metric, and macro headwinds including rate uncertainty and geopolitical tension add another layer of risk. For existing holders, patience is your edge. For new buyers considering entering now, position sizing and entry points matter more than ever. Do not chase. Watch for pullbacks and build gradually. Shifting now to one of the more telling stories of the week, defensive sectors sent a clear message to anyone paying attention. Utilities, consumer staples, healthcare, and gold all saw meaningful capital rotation during the peak uncertainty days midweek, and our animated flowcharts make that movement hard to ignore. When you see money moving out of growth and into these traditionally lower volatility areas, that is a textbook risk-off signal. It tells you institutional investors are prioritizing capital preservation over return chasing, and that shift in behavior matters. Historically, when defensive names begin outperforming on a relative basis, it suggests broader market participants are pricing in elevated uncertainty ahead. Not necessarily a crash, but a meaningful recalibration of risk tolerance. For viewers tracking sentiment week to week, this rotation deserves serious attention. It is not noise. It is the market quietly communicating that confidence in the near-term outlook has softened, and smart money is repositioning accordingly before any headline forces their hand. Within the defensive rotation, two names stand out as particularly compelling anchors right now. Procter & Gamble continues to demonstrate the kind of pricing power that holds up regardless of macro turbulence. Its ability to pass costs on to consumers without meaningful demand destruction, combined with a dividend that has grown consistently for decades, makes it exactly the type of holding that earns its place in a portfolio when uncertainty is elevated. Duke Energy tells a different story but arrives at a similar conclusion. As a regulated utility, the vast majority of its revenue flows through structures that are essentially shielded from oil price volatility, giving it a stability profile that few sectors can match in the current environment. And then there is gold. After a period of relative quiet, gold has seen genuinely renewed interest this week, driven by a softening dollar and persistent geopolitical risk. For investors seeking a non-correlated hedge, the setup is worth paying close attention to heading into next week. Shifting now to cryptocurrency, let's talk about what Bitcoin and Ethereum did this week. because there are some genuinely interesting dynamics playing out beneath the surface. Bitcoin had a choppy week, no question about it. But here's what stood out. Even on days when equities were selling off, Bitcoin ETF inflows held up surprisingly well. That tells us institutional buyers are not panicking. They are using dips as accumulation opportunities, which is a meaningful signal worth paying attention to. The animated ETF flowcharts you are seeing on screen right now show that institutional activity remained consistent throughout the week, even as retail sentiment wavered. Ethereum, on the other hand, has been lagging Bitcoin in terms of price performance. It has not broken out the same way. However, that gap is exactly why some analysts are flagging Ethereum as a potential catch-up trade. When Bitcoin consolidates and Ethereum starts closing that performance gap, that divergence often resolves quickly. So where does this leave you, practically speaking, heading into next week with crypto? If you already have existing exposure to Bitcoin or Ethereum, the move here is straightforward. Hold steady. The ETF inflow data we discussed suggests institutional conviction hasn't broken down, and panic selling into choppy but fundamentally supported price action rarely serves long-term investors well. For those considering new positions, patience is your edge right now. Watch for a confirmed hold above key Bitcoin support levels before adding. A day or two of closing above those levels on meaningful volume gives you a much cleaner risk-reward entry than chasing intraday moves. The bigger picture here is genuinely important. Crypto is maturing as an asset class faster than many traditional investors expected. ETF flow data has become a real, trackable leading indicator of institutional sentiment, not just retail noise. Make it a weekly habit to check those flows alongside price action. That combination tells a far more complete story than price alone ever could. Pulling everything together, this week delivered a market shaped by four converging forces. Iran's ceasefire uncertainty kept oil volatile, which complicated inflation readings and pressured the Federal Reserve to stay cautious. Earnings season offered selective wins, but no broad green light for risk-on positioning. What does that mean practically? This is a market that punishes lazy broad exposure and rewards disciplined selectivity. For next week, consider trimming Exxon and Chevron into any oil-driven strength. Watch JP Morgan for follow-through on trading revenue momentum. NVDA remains a hold for existing positions, but new buyers should wait for macro clarity before adding size. On the defensive side, Procter & Gamble and Duke Energy remain steady anchors worth holding. Gold continues to deserve a small portfolio allocation given persistent dollar weakness. The overarching theme is patience. Do not chase. Let the setups come to you. Selectivity is not just a strategy this week, it is the strategy. To wrap everything up, this week reminded us that selectivity is everything right now. Energy stays volatile, financials face a mixed rate picture, tech remains macro-sensitive, defensives are quietly signaling caution, and crypto is maturing faster than most expect. The single sharpest takeaway from this week is simple. The market is not rewarding broad bets, it is rewarding precision. Now here's your bottom line for the week of April 20 to 24, 2026. In uncertain markets, the investors who win are not the ones predicting the future, they are the ones managing risk better than everyone else. If this recap added value to your week, please hit like, subscribe, and turn on notifications. The Wednesday midweek pulse drops in 4 days, the Friday short follows, and next Saturday brings the full recap again. Drop a comment below telling us which sector or stock you are watching heading into the new week. See you Wednesday.